Have you ever found yourself, dreaming of trading with a really massive account, way beyond your current capital? It's a pretty common thought for traders, right? And prop firms, well, they often dangle that exact opportunity right there. Super tempting. But here's the catch. There's often this huge gap between how it looks and how it actually works in the prop firm world. So in this deep dive, we want to cut through some of that hype. We want to review the truth, really, about why most traders seem to struggle with these firms. And more importantly, we want to equip you with the knowledge to approach them strategically. We're going to unpack some honestly surprising facts that might just challenge everything you thought you knew. And then we'll guide you on how you might actually make them work for you or, figure out if maybe they're not the right fit at all. Okay, so let's dive in. Let's unpack this. What's the first big thing that usually shocks traders about these advertised account sizes?
Yeah, it's fascinating, the marketing versus the nuts and bolts. So you'll see a firm advertising, say, a $50,000 futures account, and a trader thinks, "Wow, $50,000 amazing." But the reality, your actual risk capital, the absolute maximum you're allowed to lose before they shut the account down, might only be something like $2,000.
2000.
Yeah, just 2000. So practically speaking, what you're really dealing with is effectively a $2,000 account. And crucially, these are almost always intraday only. You can't hold trades overnight. That fundamentally changes how you have to approach things, your strategy, your risk management, everything.
That's a massive difference, isn't it? $50,000 versus $2,000. The headline number is almost, well, misleading. So, okay, you wrap your head around the $2,000 reality.
Yeah.
But then comes the next hurdle, and this one's a biggie. The profit
Yeah.
target, the math on that gets even crazier, right?
Yeah. Oh, absolutely. It really does. And if you connect this back to the bigger picture, it shows just how ambitious, maybe even unrealistic, these hurdles are. For that same $50,000 account, the profit target is usually around $3,000. Now, the marketing spin is, oh, that's just 6% of 50,000. Sounds reasonable, doesn't it?
Yeah, 6% that's okay.
Right. When you remember your actual capital, your max loss is only $2,000, that $3,000 target. It's not 6%. It's a huge 150% return they expect you to make on the actual risk capital just to pass the evaluation stage.
Whoa, 150%.
150%. Think about that. You basically need to triple your usable capital just to get through the door. Most pro fund managers would dream of that in a year, and believe it or not, on some of the larger advertised accounts, that target can creep up even higher, sometimes towards 200%. It's a totally different ballgame than what they advertise.
Yeah, that's staggering. 150%. It almost feels like they're setting people up to fail from the get-go. Is that fair to say?
Well, it's certainly not setting them up for easy success, that's for sure. Especially if you're new and haven't quite grasped these underlying numbers. And then, just to make things even more interesting, you've got the max trailing loss rule.
Ah, yes, the infamous trailing drawdown.
Exactly. That rule can really throw a wrench in your plans and frankly mess with your head. And it raises a big question. How does constantly having your loss limit follow you up affect you psychologically and strategically?
I've heard so many stories about that one. People hit the profit target, feel amazing, and then boom, disqualified because their highest point dragged the loss limit up too high. Can you break down how that works? Why is it such a trap?
Sure, there are generally two flavors: intraday trailing and end-of-day trailing. The end-of-day version is common. It can genuinely make you feel like you're starting from zero every single day, even if you had a winning day before. See, your maximum loss level doesn't just sit comfortably below your starting balance. No, it trails behind your highest account balance watermark.
So if you make money,
If you make money, your allowable drawdown actually shrinks relative to that new peak. The floor comes up behind you. It often forces traders into this pattern of taking really small, consistent wins, like base hits in baseball, because you can't afford a normal pullback that might be part of a bigger winning trade setup.
because that pullback might breach the now higher trailing loss limit.
Precisely. It encourages a certain type of conservative trading, which isn't necessarily bad, but it definitely penalizes strategies that might involve holding for larger moves or enduring minimal market chop.
That must be incredibly frustrating, like the goalposts are constantly shifting. Okay, so you navigate the account size illusion, the huge profit target, the trailing drawdown. What about actually getting paid? Because I hear whispers, well, more than whiskers, that getting your payout can be yet another challenge with some firms. Surely they can't all be like that. How do you tell the good from the potentially bad?
Well, this is where understanding their fundamental business model is just crucial. For many prop firms, let's be honest, the main revenue stream comes from failed evaluations. Think about the numbers. The vast majority of people who try, probably 95%, maybe even up to 99%, they don't get a single payout.
95 to 99% fail.
That's the reality for many. Their evaluation fees, the $50, $100, $200 you pay for the challenge that money funds the firm's operations and pays out the very small percentage of traders who do become consistently profitable. So you absolutely need to be cautious when choosing because, yes, some firms flat out don't pay, or they have incredibly complex rules designed to make withdrawing profits difficult. And sometimes it's subtle. They might use psychological tactics almost like a casino playbook.
Like what?
Like sending emails saying, "You're doing great, keep it up," when you're funded. It sounds supportive.
That's nice.
But it can also be a form of conditioning. It strokes the ego, maybe encourages you to take more risk, trade bigger, and then you blow the account. It benefits them if you fail, even after getting funded. A huge red flag is if a firm never actually moves you to a live real money account. If you're always on a sim, even after passing, be very wary. That often signals problems down the line with payouts getting denied or blocked. Real legitimacy comes from transparency, clear rules, and a track record of consistent payouts.
Wow. So it's almost like a filtering mechanism where the evaluation fees from the many pay for the success of the few.
Okay, this sounds like a pretty tough landscape, but look, if you're listening and feeling a bit discouraged, don't despair. Understanding the challenges is the first step towards figuring out how to overcome them. And the solution, really, it starts with resetting how you think about these accounts. There's a strategic way to play this game. So how should traders start managing their risk effectively, given all this?
Right. This is probably the most critical piece for survival. You absolutely have to internalize what we talked about earlier, that $50,000 account with a $2,000 max loss. It is a $2,000 account, period. So you manage your risk based on that $2,000, not the $50,000. If you're using, say, a standard 2% risk rule per trade on $2,000, that's $40 risk per trade. Max.
$40. That's tiny compared to 50,000, which means you almost have to start with micro futures contracts or very small Forex lots. These smaller contract sizes let you control risk precisely and stay within that $40 limit. They become your best friend, especially early on. It's all about staying in the game long enough to learn and adapt.
That makes perfect sense. Focus on the real capital at risk.
Yeah.
But okay, trading with $40 risk, the reward seems small, maybe far away. How do you build the consistency needed when it feels like such slow progress? This leads us to something I often talk about, which I call the 30-day challenge. It's less about the prop firm rules and more about forging discipline under pressure.
The core idea there is building the habit of consistent trading under realistic pressure. It's pure discipline building. The goal isn't even necessarily profit initially. It's to achieve 30 consecutive days of stable, consistent trading. Maybe targeting a small, achievable daily goal like $100 to $300 using only micros. This isn't about passing the prop firm's evaluation yet. This is about hitting your own personal consistency benchmark. You need to set a hard maximum daily loss limit for yourself, and the focus is laser sharp on consistency and discipline. Did you follow your rules today? Yes or no? If you break any of your own rules over trade, exceed your loss limit, revenge trade, ignore your strategy, the count resets. Back to day zero.
Ouch. Back to zero.
Back to zero. It sounds harsh, but it works. You might feel frustrated, desperate, you might think it's pointless sometimes, but those feelings, those are the exact emotions you need to experience and learn to manage in a controlled way. My advice is, don't even try to get funded until you can nail this 30-day consistency. Even if you somehow pass an evaluation by luck before that, do another one. This is about building the skills to survive long-term and journal everything, all 30 days. Your trades, why you took them, how you felt, did you stick to the plan? It might take months. You might restart many times. That's okay. That's part of the process. But when you finally get through those 30 consecutive days, you will know deep down that you can trade. That doubt, can I actually do this? It just vanishes. Your questions change. They stop being about survival and start being about growth, about scaling.
That's a really powerful shift in mindset, isn't it? Moving from can I to how do I grow this?
Yeah.
So, okay, you've battled through, you've forged that consistency with the 30-day challenge. You know you can trade discipline. Now what? How do you scale up and actually start building capital?
Right. So you take that skill, you just hone the skill of slow, disciplined growth, and you apply it directly to your first funded account. You grow it patiently, you focus on consistency, you start taking payouts. Small ones at first, maybe, but real payouts. Then strategically, you use a portion of those payouts to acquire more funded accounts. You start building a portfolio of accounts. And your approach to future evaluations changes too. Once you're consistently profitable, once you have payout money coming in, you don't need to grind out evaluations with tiny risk anymore. That takes too long.
So you approach evaluations differently.
Exactly. You can strategically increase your risk during the evaluation phase for new accounts, aim to pass them faster. If you blow an evaluation, okay, it stings a little, but you can cover the cost from the payouts you've already taken from your existing funded accounts. It becomes a calculated business expense, not a disaster. The whole mindset shifts. First, it's disciplined survival. Then, once that's mastered, it's strategic, accelerated growth using the firm's capital funded by your earlier successes.
That's really smart. Turning the evaluation cost into just, a cost of doing business to acquire more capital leverage. Okay, so let's try and tie this together with some numbers. Factoring in the real capital, the targets, the payout splits, the scaling idea, what kind of actual leverage are we talking about here on your own money? It gets a bit complex, right?
Yeah, let's try to break down what I sometimes call the fiat leverage math. It helps put it in perspective. Let's say, hypothetically, it costs you all in maybe $300 or $400 to finally get that $50,000 funded account. Maybe you failed one evil, paid activation fees, whatever. So for your $300 or $400 of real cash, you're getting access to that $2,000 of simulated but tradable capital in the funded account, the max loss buffer. That's roughly 5x leverage on your initial cash outlay, but it's sim leverage, right? Because it's on their platform.
Okay, 5x sim leverage.
Now, let's factor in the payout. If the firm offers, say, a 50% split on profits, that $2,000 of sim capital, if you could theoretically trade it perfectly risk-reward 1.1 and take profit, could generate $2,000 in sim profit. Your 50% share would be $1,000 in real cash withdrawn. So your initial $300 to $400 investment potentially yielded $1,000. That's like 2.5 to 3x real leverage on your money, assuming you can actually extract the profits.
2.5 to 3 times your money.
Potentially, yes. It shows the leverage potential. And it's a big if you've developed those consistent trading habits we talked about. But, and this is a huge warning label, do not try to treat this like a simple coin flip or a pure statistical gamble. You can't just say, I'll risk the 2,000 to make 2,000,
Right.
Because prop firms have rules specifically designed to prevent that. Things like consistency rules, max daily loss limits, the trailing drawdown itself. They stop you from just taking one massive punt and hitting a jackpot. They want to see smooth, consistent profitability over time, not one lucky home run. Their rules enforce that.
Got it. So the leverage is there, but you have to earn it through discipline, not through gambling. Okay, Jane, we've covered a lot of the challenges, the tough targets, the tricky rules, the business model. Listeners might be thinking, wow, is there any upside here? And the answer, maybe surprisingly after all that, is definitely yes. Especially for newer traders, I actually think the positives can often outweigh the negatives. What do you see as the biggest benefits?
I think the number one benefit, particularly if you're starting out, is experiencing skin in the game, but with a very controlled downside. Look, prop firm evaluations are just so much better than paper trading alone. Why? Because you're putting down real money, maybe $50, maybe $200 for that $50,000 challenge. That small amount creates genuine psychological pressure. It's real. You feel it in a way you just don't with a demo account.
That emotional pressure is key.
It's absolutely key. But here's the beauty of it. Your maximum loss is capped at that evaluation fee. You're not risking your life savings. You're not risking thousands from your personal trading account. You're risking maybe $100. It's an incredibly affordable way to feel the real psychological demands of trading, make mistakes, learn tough lessons without facing financial ruin.
That's a huge advantage. Learning under pressure, but with a safety net. And of course, for people struggling with not having enough capital to trade meaningfully,
Right.
prop firms can be an absolute game changer there.
Oh, definitely. If lack of capital is your main bottleneck, these firms offer a clear, structured path to scaling up significantly faster than you likely could on your own. Many firms allow traders to manage multiple accounts simultaneously, sometimes 5, maybe even 10 or more. And often you can use copy trading software to manage them efficiently. So imagine, you get good, you pass 5 evaluations, each has that $2,000 max loss buffer. Suddenly, you're managing $10,000 in effective trading capital.
$10,000.
$10,000. And getting there might have cost you, let's say, around $1,000 in total evaluation fees and costs.
Yeah.
That kind of capital access for that kind of outlay is just unavailable almost anywhere else for a retail trader. The caveat, of course, is what we discussed earlier. Get good with one account first. Pass it, get funded, take payouts, then use those payouts to patiently scale up. Don't try to run before you can walk.
Absolutely. Build the foundation first. And, beyond the money, beyond the capital, trading in this kind of environment, it really teaches you about yourself, doesn't it? It's like a mirror.
That's probably the most profound yet often overlooked benefit. Making a real concerted effort to get good at trading, whether you ultimately make millions or just break even, is an incredible journey of self-discovery. It forces you to confront your discipline, or lack thereof, your emotional control under pressure, your ability to think strategically and stick to a plan when things get chaotic. Trading truly holds up a psychological mirror. And the skills you hone, that emotional regulation, the strategic thinking, the resilience to bounce back from losses, these are invaluable life skills that transfer to pretty much everything else you do. But we have to add the warning again. Approach it like a craft, like a serious skill to be developed. If you treat it like a casino, like a pure gamble, it can be addictive and financially and emotionally damaging. Respect the process.
Well said. Treat it as a skill, and the personal growth can be immense. And sometimes, as the author we're drawing from found, the very constraints of the prop firms can push you to become a better, more strategic trader overall.
Exactly. Those tight loss limits, those high profit targets, while they feel restrictive, they can force you to seriously reevaluate your entire approach. You have to become more precise. You have to manage risk meticulously. You might have to adapt your leverage strategy. This pressure cooker environment can actually lead to refining your strategies, making them more robust, more efficient improvements you might not have discovered. If you just had unlimited freedom and capital, it can genuinely elevate your trading game.
So wrapping things up, we've seen the challenges, we've seen the surprising benefits. Knowing all this, are prop firms the right path for every trader? Probably not. When might they not be the right fit?
Yeah, it really comes down to alignment. If your trading strategy, one that you've proven works for you, inherently requires a larger drawdown tolerance than prop firms typically allow, maybe you need wider stops, maybe your system has bigger swings, then the tight rules might just break your strategy. Or if you're fortunate enough to already have significant risk capital of your own, and you're perfectly happy aiming for maybe smaller, steadier returns on that capital without answering to anyone else's rules, then the constraints of a prop firm probably aren't worth it. You value the autonomy more.
And trading style limitations like day trading only.
Right. If you're fundamentally a swing trader needing to hold positions overnight or for several days, and the firm strictly enforces intraday trading only, then it's simply not a match. Your strategy won't work within their rules. It's all about asking, do these rules and constraints complement my proven edge, or do they fundamentally conflict with it?
That's the key question. This whole exploration of prop firms, it goes beyond just the rules and the money, doesn't it? It's really about understanding yourself as a trader within this specific game. The author we looked at found that diving into this world actually shattered some limiting beliefs they had and completely transformed their trading. So maybe the final thought for you listening is this. What limiting beliefs about your own trading capabilities might you be holding on to right now, perhaps without even realizing it? And could tackling an unexpected challenge like navigating the prop firm world actually be the catalyst for your biggest breakthroughs?
If you love this content, found it valuable, please share it. Please make sure you click like on this video and subscribe to our channel for more content like this.